Good afternoon, ladies and gentlemen, and here we are for the next instalment in the Admiral Markets Trading Spotlight webinar series. And today we're here to talk about how to trade oil markets. My name's Paul Wallace. I'm your host for today's session. I hope you are all safe and well wherever you're joining us from around the world. We're here at Admiral Markets. We appreciate we're in rather interesting and turbulent times. However, there is still the opportunity for us to learn and be educated about markets and to engage with markets. And as we said today, we're going to talk about oil markets, which is rather an apt subject topic based upon what we'll have seen over the last month or so within oil markets. So there'll be lots there for us to cover and to dissect and to talk about today. But thanks very much for joining us. We love having you all here with us today. If you've if you've got some experience of trading oil markets, we'd love to hear about what your own thoughts are. Please pop them in the chat box. Or alternatively, if you're watching this later on demand on the Admiral Markets YouTube channel, and you like the webinar, please give us a like. Or if you've got questions, please do. We'll be happy to help you. Or if you've got thoughts about future topics you'd like to see us cover on the Trading Spotlight webinar series, please pop them in there. We'd love to hear your thoughts and your feedback, and we can build that into our future program of trading webinars. Well, what we're going to talk about today is a little bit about the different types of oil instruments that you can trade with Admiral Markets. Also about what in particular does a trader need to be aware of before trading the oil market. We'll cover how to best position yourself to succeed at oil trading, and I'm going to share with you just a couple of simple tactics for trading oil successfully. And we'll talk about that, and stick with us till the end, because if we have the time, then we'll try and have a little look at the live market and see what's been bubbling up there over the last couple of days in the oil markets. So for those who don't know me, as I said, my name's Paul Wallace. I've been trading for many years. Okay, I've traded both institutionally and privately. Primarily for my own trading, I like to trade be a dominant trend trader for my swing and position trades, but I'm a reversal and mean reversion trader on an intraday basis. And as you can see, the Admiral Markets has a wide range of instruments that you can engage with markets as well as the oil markets. And they are licensed and regulated across a wide range of regulatory environments, providing competitive spreads. And you can engage with markets through the MT4 and MT5 platform. And if you have any further questions, please get in touch with your account representative, and they'll be happy to guide you. So, ladies and gentlemen, as I said, let's talk about trading oil markets. Now, the interesting point is that this particular presentation was done back in February. It was created back in February, and just because of what's been happening with the market, it's only being coming out now. So it's even in these 2 months between when this was created, when we delivered, there's been massive changes in oil markets, in markets in general. So we'll build that in, okay, to make it as kind of a prescient and as apt as possible. But as we can see there, recent tensions have caused spikes in oil prices that are providing opportunities for those who are prepared. And 2020 has been a fascinating year in the oil markets. Okay, some of you may remember that we started off 2020, which was it was only 4 months ago. Okay, it might seem like a lifetime based upon what we've endured over these last couple of months, but start of 2020, we had some real moves and some spikes and some tensions in oil markets based upon, if you remember, there was some particular let's say, geopolitical tension between the US, Iraq, and Iran that had big shunts on oil markets. And then as we've seen the coronavirus, okay, has spread initially from China to around the world, that has had an impact on oil markets. And what we've seen also is that, as the globe has gone onto lockdown, that has had a knock-on demand for oil, and that has had actually huge impacts on the oil markets, which we've seen over just in the last week. So in the last couple of months, all right, the trading the oil markets has been a rather eventful experience. Okay, plenty going on there, and we're going to talk about that today and hopefully try and help you make a little bit of sense of what has been a rather eventful time. But as it says there, many people are attracted to trading oil markets because they believe they like the volatility. But, and I've said this all along, but every instrument you like to trade is, remember that volatility is a double-edged sword, okay? People like to see volatility, okay? But it's great when it's with you, but if you're on the wrong side of it, not so great, okay? So, volatility is useful, but it is a double-edged sword, ladies and gentlemen. You have to remember as a trader. So, as with all markets, you have to be prepared and you have to know what's in store for you as a trader. And some traders might say that that's been rather challenging over the last month or two, okay, with regards to oil. But there is always opportunity. There is always something to be gleaned, something to be taken, some value to be extracted, okay? And it's our job as traders to help provide you today just a sort of a simple introduction to trading oil markets so that you're prepared for what awaits should you be looking to engage with them, And it is, as I say, it's an introduction, okay? Oil trading in itself is a kind of, it's quite a deeply complex and deeply sort of nuanced experience. So, and we could do months of actually just talking about how to trade the oil markets. Today, we're going to provide you with just an educated introduction to understand the oil markets, so you're prepared for what awaits. And I do appreciate, we, as I said, we love having you all here and stuff. But I appreciate we also have a very broad range of experience, okay, for our traders, from people who are just completely beginning with the trading to others who are, quite experienced traders and will have experience of trading the oil market. So we try and cover the entire spectrum. And as we said, if you've got questions or thoughts on the oil markets, please pop them in the chat box. We love to hear it, okay, and it helps us understand, how we can help you the best possible going forward. So, before, I've talked about this before, before you actually look to engage with any markets, okay, especially if you're going to be doing it on a shorter time frame, okay, it is important to set the right pre-market routine. And we're talking about oil today, but it doesn't really matter whether you're trading cryptocurrencies, whether you're trading, sort of agricultural commodities, whether you're trading FX, you're trading fixed income, you're trading, indexes, okay. It's, remember, if you're going to be using price action, okay, price action trading plan should be simple and clear, especially when intraday trading any instrument. And part of this is about making sure you have the right pre-market routine, okay? And it is about setting yourself into a right routine, but setting the right habits and behaviors in the way that you look to engage with markets. So, what we talk about is, whenever you're opening on a chart, and today we'll look at it on oil, but you need to identify significant levels on the monthly, the weekly, and the daily charts, okay? Because you want to do that. You don't want to be sort of selling into support or buying into resistance. You want to know where those big particular levels are. You're looking for price action triggers at those particular levels. And if you need to understand price action more, well, then please go back into the Trading Spotlight webinar archive. You'll find on the YouTube channel. You'll find on Traders Yard, okay? You'll find it on the Facebook group for Admiral Markets, and you'll find that we've got a couple of fantastic videos in there, okay, and webinars that can explain price action trading to you pretty simply. So if you're a little hazy on that, or if you need a refresher, please go and avail yourself of those particular trading price action trading webinars. So what we all say is, if you're going to enter a trade, be sure to wait for the break of a candle. Sometimes, especially if the price action and they see an engulfing candle forming or what looks like a rejection candle forming, people get excited, okay, they think there's a trade on, and they sort of take the trade early before the trade has completed, okay, before that candle has actually completed. So wait for your candle to complete, and then, when you're entering a trade, be sure to wait for the break of that candle in the most part when you're just starting out. Stop loss is important to have a stop loss, and it should always be, on the other side of the candle or on the kind of recent high and low. That makes sense. Never risk more than 1% of your capital on a trade, and look to to be targeting either kind of 2 to 1 or more in terms of the reward for your risk, or the next significant level in the particular move. And so always important to record what you're doing, review it, and then repeat it. Okay, it's a process. Okay, it's not about you being right on one single trade. It's actually more about can I be right over 20 trades? Okay, can I actually be good over 20 trades? Okay, and once you've got a block of 20 trades, you're able to review them. You're able to take out the good learning points. You'll be able to sort of take away any kind of bad habits and start to sort of move them away, and just see where your areas of development for. Okay, and then you can just roll forward in sort of almost like boxes of 20 trades, okay, just getting better and better trade box by trade box, rather than just being focused on the outcome of one single trade. So, you know, and just to follow on from that, okay, because it's always key, we always want to stress the kind of the basics and the fundamentals that need to be in place to ensure you're doing it right. Okay, let's just set some very simple rules and expectations for when you're engaging in markets on an intraday basis. Risk management is absolutely key. You have to honor it. And once again, if you're not fully aware or fully understanding of risk management, there are some great videos, okay, in the Trading Spotlight webinar archive, so please go and avail yourself of them. Ensure that you know what news is coming out for that session. Okay, it's not hard. There's an economic calendar. You can find one on the Admiral Markets website. Okay, there that will allow you to know what are the, let's say, the formal economic news coming out. Admittedly, during these rather interesting times, should we say, that news comes out that is not on that calendar because of there's panic meetings, okay, or calls between particular financial institutions or major players, okay, and that that happens to all of us, and that's why there's some elements of of social media, okay, that you can copy to keep on top of that. But in terms of the formal economic calendar, there's no real excuse not to be knowing what kind of news is coming out for that particular session. I find it better to conduct your analysis before trading. What does that mean? That means sit down, okay, before you're actually determined and committed to actually taking your trades. Do your analysis. Maybe like me, I do a lot of my analysis at the weekend, okay, when the markets are shut. It means that I've got no distractions. It means there's no impulsive moves. I can sit there, I can make my plan, and then carry that through into the week ahead. Resist the temptation to trade out of session. What does that mean? Well, that means that there are a couple of particular blocks of time when it's it's ideal to be trading any instrument. Okay, it's about understanding that. And outside of that session, well, then you just struggle to sometimes find the kind of either the volatility or the move or the market cannot necessarily be suitable to being trading outside of the main sessions. As always, ensure you've got yourself a good internet connection. I know that might go without saying, but I appreciate, as I said, we have people who join us here from all over the world, okay, and whose, let's say, levels of internet expectation may be different. So it's just make sure you have a backup, make sure you have plans in place in case there's a challenge. And ensure that you're rested and prepared for the session, ladies and gentlemen. All right, okay. It's if you're a tired trader, you're going to make tired choices. Okay, so just make sure that you're rested and ready and prepared for your session. You owe it to yourself. So, those are the elements that, I would expect all good traders, regardless of what you were trading or how you're trading, to be sort of, on top of. But in particular, when we come to looking to trading oil markets, what we're particularly looking at in terms of what's available to you on the Admiral Markets MT4 and Admiral Markets MT5 platform is that oil trading is effectively offered as two contracts. All right, you either have Brent crude oil or West Texas Intermediate, WTI, you'll hear it called. Both of these are what are known as light sweet crude oil, okay, with WTI generally being the sweeter. Now, if you particularly wish to understand more about the different variations of oil, well then please be my guest. You can fill lots of this lockdown hours sort of actually spending time investigating the difference in the gradients of oil. Today I just want to focus on how you can engage with those markets and how you can trade those markets. What we used to find is that WTI, sort of, let's say, the American crude oil, would basically trade at a premium over Brent. But now with the current supply glut, the prices have reversed, okay? And it's interesting. We can see that when we put these slides together a few weeks ago, you can see what the price was trading there. Brent was trading at 58 and WTI at 51. Let's just say that if you had shorted those at those particular prices, you'd be a very happy trader now when you were looking at this. But it's still relative, and we will be looking at that the live charts in a few moments to get an idea on what has been a rather sort of volatile couple of weeks in the energy markets. So, it's important to have a little bit of an understanding of what drives the oil market. As I said, here today, we're going to give you a little bit of a gentle introduction. There's hugely nuanced elements to the oil markets, okay? And if you find that the oil markets, the energy markets they attract your interest, you find that they resonate with you, well, then there is, some fantastic material out there that you can focus on to basically help your education. But when it comes to moves in the oil markets, the fundamentals are very important, okay? And you'll find that oil in particular is very sensitive to geopolitical events, okay? So events in the Middle East may cause spikes in the oil price, which can make the instruments volatile in times of geopolitical tension. Those events can cause huge problems with supply and demand because they will have an impact on the oil price. And oil is also sensitive to the state of the global economy. When the global economy is strong, there's likely to be more demand for oil, and vice versa. However, when the price of oil gets too high, it can cause a drag on the global economy, starting a vicious cycle. So, as I said, the oil markets are quite nuanced. Okay, it's quite nuanced. There's elements there that all have a little bit of a play on the actual state of the oil markets, and not surprisingly, the price of our two main traded contracts. So, as I said right at the start, what seems like years ago, okay, at the start of 2020, is that we had geopolitical tensions between Iran, Iraq, and the US, okay, that were having impacts upon spikes, okay, and then deflation within the oil price. And then what, as I said earlier, is what we saw is that as we've experienced the coronavirus, that has had a huge impact on supply of oil, because people have still been digging oil out of the ground, okay, and putting it into barrels, putting it onto tankers, but demand has dropped off the sort of cliff face because people aren't flying jets anymore, okay, people aren't driving cars. So invariably, all of that demand for oil has just almost evaporated over the last month or so. So of course, you've had oversupply and under demand. So of course, that is going to have a huge impact upon the price of oil, which we'll have a look at in a moment. And then, as I said, that has that knock-on impact of the state of the global economy. Because the state of the global economy isn't great at this particular moment, and there will be a drag of that, for the rest of the year, maybe even for the next 18 months to 2 years, okay, and that will have a drag upon the price of oil itself. So as we'll look at the charts in a bit, we'll start to get an understanding of how it's nuanced, how it's very sensitive to what's going on in the world, and what's been going on itself in the last couple of weeks. So when it comes to oil markets, we talked a few slides back about it's important to understand and know specific pieces of economic news that come out on the economic calendar. And there's one particular one that sort of draws the attention of energy traders, people trading the oil markets. That is, as you can see here, the Energy Information Administration, EAI, crude oil inventories numbers, okay? So as the name implies, all right, okay, this is normally released on a Wednesday afternoon, and it reports the number of barrels of crude oil commercial firms have in their inventory. And those numbers are watched very closely by the energy markets. With all news, it's about the expectations versus reality. If they're very different, then the oil market can react very strongly. So, as I've just said there, we're in a bit of an interesting period. It's almost like, I hate to use the word too much, but it is almost like historic, unprecedented times where invariably, we have been digging oil out of the ground, but there's just not people using it at the same levels that, they were merely 2 months or so ago, in terms of, especially things like for heating, for energy, for flying, for driving cars, etc. All of that demand has pretty much evaporated, okay? And that will have a huge impact, as said, on the price. And of course, invariably in terms of crude oil inventory numbers, well, you would expect those numbers to be pretty high at the moment because, well, as we'll find out, they're pumping so much oil and nobody's using it. Well, in fact, if anything, inventories are rising, and basically, actually, we're having problems with storage. That's the challenge that we're having, okay? And we'll talk about that a little bit. We'll talk about that a little bit later. So here's an example here. This is back from 20th of February, and this is a 60-minute chart of the WTI, okay, the US crude oil 1 hour chart. And what I want you to be aware of is that on a 1 hour chart, when we've got these period separators here, let's use the drawing tool, okay, just to help as always, okay? Remember these kind of period separators on the MetaTrader is basically giving us an indication of each day, all right? So the hourly chart, and you can see yourselves there, ladies and gentlemen, okay? The oil was, was just, in a nice hourly uptrend there, moving its way up until basically the news was released on the kind of Wednesday afternoon, all right, and actually price printed on the hourly chart, okay? Having price raised, it actually printed an engulfing candle, a key reversal candle there, okay, because there was a difference between the expectations and the reality in those oil inventory numbers. And actually what we can see is that basically price started to drift away. Now, if you look at that, WTI was after the end of that hourly chart, okay, in terms of the hourly key reversal, was trading around about 53.70, 53.50, okay. Just keep that price in mind, okay, there from the 20th of February, because when we look at the charts now, you'll see it's rather different. That in many ways that might well have been the high for 2020 of the oil prices there, okay, but we weren't to know that at the time. Always easy in hindsight. So but that just gives you an indication of that the crude inventories number that can have a big impact. Okay, a big impact on the sort of the trend or a change of trend within the energy markets. So when it comes to trading oil market, I prefer to trade oil on a shorter swing-term basis or an intraday preference. Oil has always been volatile, more so now than ever. But whilst volatile, at times I've found that my kind of normal versatile trader approach has been beneficial. Okay, remember I did a webinar months back now, okay, in the archive that you can check on about what does it mean to be a versatile trader. And a versatile trader, it must be able to trade any instrument in any direction on any time frame. Okay, if you have the skill sets to be able to do that, well, then what you might find is that you might find that with time you will probably focus, okay, on either particular instruments, particular direction, particular time frame. But by having an understanding, okay, of how to be able to trade in terms of having a versatile approach, that gives you the ability to sort of change attack as markets change, as we will see even in oil markets, they change over time. So being able to be versatile and ally that with the price action setups that we have covered in many of the trading spotlight webinars that both myself and also my colleagues Marcus and Jens have completed, it develops a framework for trading the oil markets. Okay, so being able to be versatile, be able to understand, okay, how to trade simple price action setups, they still are valid. Okay, they're valid for all instruments, okay, all directions and all time frames. But what I'm going to do today, okay, and trading oil markets is, oil trading, energy trading is generally less popular than FX and indices, but it still does provide us with some opportunities. Okay, the team that I work with for my own trading, we discovered a particular setup the last sort of kind of few months in sort of 2019 and into early 2020, which we started to call the Fox in the Box, which I'll share with you now. Okay, and I'll share with you now. But what I would also caveat with, ladies and gentlemen, is that these trading tactics, they work best in sort of, let's say, calmer, less volatile markets than we've experienced in March and April of 2020. Okay, so we will have a look at them. We'll have a look at the charts, but we have these particular tactics have been well, in fact, particularly all tactics have been somewhat overwhelmed by real structural shifts in those energy and oil markets, which we will look at the moment. If you've got experience of trading oil markets, you'll know exactly what I'm talking about. But equally, if you're completely new to trading, you'll also have an idea that by the end of this, what we can do. But today, I'm going to share the Fox in the Box with you. You can take it away and have a look at it and see if that might offer you an easy introduction to sort of trading the way. So what we talked about is, when I was looking at this and trading this with my team, is that, when trading oil, initially we look for failed breakouts, okay, from the Asian range, something that, I like to trade myself all the time, okay, just looking for failed breakouts, okay. So, I'm a believer that, people can trade either bounces or breakouts. My own view is that on a shorter time frame, breakouts tend to fail, and when they fail, that actually provides me for an opportunity for a reversal. And what I like to use is just a kind of a simple couple of different patterns. One of them being just a kind of a sort of like double top pattern there. Okay, a 1, 2, 3 pattern, an M pattern. There's lots of different ways you can describe it. Okay, or you can actually use an inverse head and shoulders here. So let's just draw on here. Just excuse my artwork, okay? I'm a better trader than I am an artist, all right, thankfully. But hopefully you can get an idea there, okay? We've got left shoulder, the head, and then the kind of right shoulder here. So, as I said, I like to see failed breakouts, okay? And then I like to see, reversal patterns, okay? And those are a couple of my preferred setups to wait for. And I still will watch for them and still quite like trading them, okay? When the opportunity arises, the downside to them is that they, you don't know when they're going to set up. I can't tell you oh, you know, Tuesday at 8 o'clock they always set up. It doesn't work like that. Okay, you have to wait and trade what the market offers you, and take it when it comes your way. But they are still very valid. And if you're not sure about those kind of price action reversal patterns or simple price action patterns, as I said, go and have a look on the Trading Spotlight webinar archive, and you'll find that there's actually plenty of sort of a great material in there, great previous webinars all about price action trading that will help you just refine and hone your edge. Yeah, but today what I'm going to do is talk about something else that we discovered, me and my team, okay, trade with, okay, that you know I'm going to share with you today. You might be able to utilize and help it in your own trading. And what we discovered is that the edges of the Asian range very often become the first boundaries of the first post-Asian session move. So just you know, this grey box here you'll see on my charts here. This is the WTI 15-minute chart. Okay, grey box is just the Asian session, and what we found was that you know if you project forward those kind of ranges, okay, those boundaries, okay, the Asian session range, well then very often the price provides opportunity when it comes down to sort of touch those areas itself, and that becomes of interest to us as a way and a means to actually trade. And you know what we discovered is that the edge of the Asian range, okay, so become very often the sort of the first move, okay. The grey box is the is the Asian session, and that really covers from a bit between sort of 12 till 7 UK time. And then what we kept seeing is that you know price would very often, not all the time, but very often would just kind of tap the edges of that and then reverse away from it, okay. And as I said, you know when I'm trading intraday, that's the kind of way I like to trade intraday. I like to be kind of a mean reversion sort of trader on an intraday basis that you can look at and just take away from that. But you know, go away, have a little look on the charts and just see how it is. Now, admittedly, the last kind of 6 weeks have been rather interesting in oil markets, but as generally, okay, when markets return to a little bit less volatility and calmer, which they will because they do, markets surge then rest, they surge then rest. That's the way markets operate. That's this will become more apparent to you. And what we found is that, you know, when we tested it and researched it, is that, you know, it happens enough to make it a tradable opportunity. And it occurs on both the Brent and the WTI, but we've mostly focused on WTI for our examples today. All right. So, you know, what we look at doing is, you know, how can we sort of trade one edge of the box with actually the move to the other side, okay. So So, you know, Alfred's asking a question there is that, you know, is that bank sort of hunting stop losses? It could absolutely be that, okay? Could absolutely be that, Alfred, okay? It's, yeah, you know, there will be lots of orders around those particular session ranges, and us being able to understand them and utilize them, okay, for our own benefit. Is, you know, can actually be of great value. And if you look back to, I think maybe the first webinar that I did for the Trading Spotlight series was actually around about sort of you know, kind of intraday trading FX markets, but actually quite a lot of the concepts that I discussed there are equally valid here, ladies and gentlemen. All right, they're equally valid. So you know, as I say, go back, check out there. There's some absolute gems of fantastic information in the Trading Spotlight webinar archive, so please make the most of it to sort of go back and avail yourself and watch it. You'll find that, you know, real benefit and real help to you there in your own trading knowledge. So, you know, what we've been doing and suggesting is, you know, we have like what they call an OCO order, okay, which is, if you don't know it, that means one cancels other order to basically to fade the first touch of the box, okay. So when it comes down to sort of touch one of those kind of elements of the one of those boundaries, okay, the session, we're looking in order to basically you know, to buy the bottom of the Asian session and sell the top end of the Asian range, okay. So, you know, what we had been using is, you can see here, just a 15-point stop loss and a 25-point target to provide a 1.61R reward to risk. There's a couple of things I'd say in the present climate. Okay, you might wish to change that number. Okay, that number is a little bit tight on the present volatile circumstances of those last month or two, and also, you know, whilst you will find that actually price taps that boxes a couple of times in a session, generally, you know, I only sort of trade the first one, okay, and then leave it after that. Okay, I'm not looking to sort of try and get as much out of it as possible. I'm just basically sort of taking, you know, one tap and go. That's me. You know, that's the way we look to like to trade it. So, you know, no trade setup is perfect, ladies and gentlemen. Okay, there is no perfection in trading. If anybody tells you there is, they're talking nonsense. Okay, it's about being able to find a way to trade. You know, the trade consistency with discipline. Okay, that allows you, as I said right at the start, to basically to be profitable over, you know, blocks of 20 trades. Okay, not the outcome of each one single trade. Okay, trying to attach your self-worth to the outcome of every single trade is just a recipe for disaster. So, you know, as I said, no trade setup is perfect, and you know what we've seen. Okay, of course, in the volatile markets we've seen over the last, you know, sort of few weeks, is that, you know, that can change quite rapidly in terms of your setup. But it's how you utilize that loss that determines your next success. So, you know, on this particular example here, you know, what we can see is that, you know, when price came down and tapped the kind of the low of the Asian session, you know, if you were fading that and buying into it, well, actually it failed. Okay, it failed, and that. But what that means is that, you know, you're now being given, you've just paid for some information from the market. That's the way to look at it. You don't think of it in terms of like a loss. This is a business. You think of it in terms of, right, I've just paid the market for some information here, okay? And what that market is, that information is that basically that's telling you that this is very likely to be, you know, a trending day, okay, within the oil market. So as you can see in this particular case, when price pulled back up towards the boundary, towards the 50 period moving average, it actually put in a 3-bar reversal there, which then allowed you to basically short the market, okay, for the rest of the European session. So, as I said, no trade setup is perfect. Okay, anyone who tells you is talking rubbish. It is, you know, you are like any trade, you will take, you know, business expenses in terms of losing trades. It's actually how you use that information. Think of it in terms of you've paid the market for some information, so you should want to be looking at, well, how can I use that information to help me in my next trade setup? So, you know, here's an example here. This is, you know, from January of this year, okay? And, you know, you can see what happens there, right? So, yeah, upon testing, we realized the moment it happens enough to make it that tradable opportunity, and it occurs a lot on both Brent and WTI. But, you know, you can see yourself here, okay? Just, you know, we can see how price taps and moves up, and then it basically taps the other side of the range and moves down again. Okay, so some people would want to try and trade everyone. Personally, I just like to trade the the first move. Okay, and if that happens, and then, you know, I'll take that trade and play it however it particularly plays out for me. You know, here's examples here. Okay, is that, you know, where, you know, we can see where it comes down, and it, you know, sort of it doesn't hit our stop before it takes us up to our target, but then on the kind of the next one, it's, you know, it just, we're kind of in by the skin of our teeth here, okay, before it drops down. Right, we were just very fortunate because it was a very tight range there. Okay, but as I said, no trade setup is perfect. It's about being able to sort of work with what is seen. And there's a few examples here, okay, and, you know, as always, that's just to show that, you know, there's different examples here. We can see that price came down and tested before it moved up, okay, and hit our targets, but then invariably it also tapped the top end before dropping down again, and actually you might say that, well, actually Paul, it sort of drifted up there again. It's a case of, you know, it's a case of, you know, happening. It will happen sometimes, a couple of times, maybe a few times. Personally, I said I just prefer to just take the first trade and move away after that as my own kind of as my own particular trading styles. So, you know, it's just quite a few examples here as we were going through sort of January, as I said, you know, and we can see that, you know, as price moves up, you know, it taps the first one, it comes down and takes us our particular particular target on the first one. Okay, and it's as I said, it's quite simple, quite mechanical. It's a case of actually just looking to work upon that, all right, in terms of working at it every single day, because we're looking at it as we enter the European session. That's what we're looking for. Okay, as we've had a kind of a bit of a consolidation overnight in the Asian session, and then we start to get the moves out. Okay, starting to look at testing the boundaries, testing to see where the other particular orders are. Okay, and that can be the way we utilize to help us with our own particular with this particular trading setup. So, as I said, there's kind of examples of, it's a case of, in this particular one, we had that, we had basically the price didn't tap the top end. Okay, it came down and it hit the low end. Okay, and what we saw was, it didn't hit our stop loss, but as it came up, okay, we could see that actually that particular trade ended up failing, because it pulled in, and we could see that actually this was becoming a trending day. All the moving averages were starting to sort of fan out in a way, and actually price rolled over and fell away. And as I said, there's no perfection. Okay, there's no absolute perfection, but what we're looking to do is to have, when you've got a 1.5, okay, 1.6 reward to risk ratio, well then anything above 50%, okay, on your hit rate, well then that starts to put you into having positive expectancy, and that's what we're looking to. As I said, it's looking about how you can achieve this over a block of 20 trades. Okay, not off one individual one, but actually how you can achieve that over a block of 20 trades. I mean, we can see here, just examples after examples here. We had quite a big range here. Okay, this is the WTI, big range. Okay, basically this is price gapped down on its open, fell. So we had a big range, but price still came down. Okay, price still came down. Right. Okay, tapped our area, actually put itself into I would look at that as an inverse head and shoulders before it actually moved its all the way back up there. Didn't quite make it to the other side, okay, of the range. But as I said, I'm only really looking to take the first move into that range there. Okay, that's so the first move to the boundaries of the Asian range. That's what we're looking for in terms of where we're looking to sort of do our business as traders. And as I said, we'll just try to sort of show examples of this was through how we traded it through January. Okay, and we can see here very early doors. Okay, straight out of the very early in the European session, prices come up. Okay, and it's tapped the top of the Asian range before dropping down. Okay, hitting our target and also hitting the sort of the southern part of the range. Okay, the bottom part of the range before it then dragged itself back up, hit the top part of the range again before falling down again. So, effectively you might say there was like three, and then it actually came through it, pushed through it in the end. So there's four sort of four, you might even say 4 or 5 times where price tapped the kind of edges of that particular Asian range, and that's what you're looking for. As I said, I personally just like to prefer the first one, but more aggressive traders, okay, or if you have real experience and knowledge of trading the oil market, might wish to sort of to sort of take all of the particular trades to set up. That would be your choice based upon your trading knowledge and experience. And here, here's an example where actually price had just really kind of gone sideways for most of the session, all right, the 29th of January, and then price pops up, takes our order, and then drops all the way down to the other end of the spectrum. Okay, the other side of the range. Okay, so as I said, it's at some point it's probably going to look to tap it, and that's what we're looking to try and just basically do. And it is, as I said, it's the kind of the fox in the box here. Okay, in terms of a very simple trading tactic that you can take away and work on. So, as I said, there is probably a time-sensitive opportunity. Well, it has been in the sense that we have the oil market has been overwhelmed by huge, bigger sort of geopolitical and structural issues that have happened over the last couple of weeks. It's far from 100%, okay, all right, but because you've got a healthy reward to risk, okay, anything over 50% provides you with good, positive expectancy. And on days when it does fail, then you have the likelihood of perhaps a trending day setup, and then you can trade with that accordingly. Remember, if you've had a losing trade, you just look at it as in terms of you've just paid for information from the market, and it's a case of how you use that information will help you maybe for the rest of that particular session. And as I said, we caveat that with these particular trend tactics. It works well, and we've got a couple of minutes. We can have a look over how it's worked through April. But invariably, as a general rule, prefer to sort of trade it in calmer, less volatile markets than we've experienced in the particular period over the last month or two. So, in conclusion, ladies and gentlemen, geopolitical tensions have caused spikes in oil, okay, and there's been, that geopolitical tensions covers invariably issues in the Middle East with Iraq and Iran, issues in China, and then issues globally because of coronavirus. And that provides volatility, and volatility is attractive to many traders as it will provide opportunity. But as I said right at the start, volatility is a double-edged sword, all right? You need to be prepared for that. It's important to be aware of the upcoming news items, okay? And whilst the oil markets, it does march a little bit to the beat of their own drum in the sense that, it does its own thing based upon geopolitical tensions, still provides price action opportunity if you're a versatile trader. Trending days provide the chance to use price action to join the trend, and range-bound days, okay, always provide the opportunity to use that fox in the box setup. But of course, most importantly, manage risk every single session and every single trade every single day. So I think we've got maybe a couple of minutes. We'll just try and have a quick look at the market themselves. But if you want to learn more, okay, come and join us in Traders Yard. Okay, you can see tradersyard.com/group/312. I'm going to be in there for the rest of the day. So if you've got questions about this webinar or about all the things that's going on in the markets, come in there, drop in there. You'll see my colleagues, Marcus and Jens. They're always posting some great stuff in there. There's loads of fantastic information and help in that portal. Also, don't forget to join us next time. You can join my colleague Marcus, Kate, on Wednesday to learn about how to improve your trading patience and discipline, including the importance of discipline and patience in trading, and some top tips to improve your discipline and patience. And that'll be on Wednesday, 29th of April. And as always, check your inbox for the webinar link. There's always plenty of good stuff on the admiralmarkets.com website that you can find there. And if you want to contact us, well, you can contact us on email, hello@admiralmarkets.com. You can check out this webinar and all of the rest of the Trading Spotlight webinar ones on youtube.com/admiralmarkets. If you found this helpful or useful, give us a like or put in a question, and also on facebook.com/admiralmarketsglobal. So I hope you found that useful. I hope you found that interesting. We've got about, just about 2 minutes or so left. We'll just quickly switch across and just have a quick look at one or two of the recent sort of price actions that you can see on oil. As I said, it's today is about a basic introduction to oil trading. It's a very nuanced market. But if you'll just bear with us a second, let's see if we can go and switch across to the charts there for the last moment or two. And just 1 second, bring it up. Okay. Hopefully you can all still see me and hear me, and hopefully you can see the charts here. I have a profile here that's set up in commodities, and I've got here that I can just keep an eye on all of those. And what we're looking at is let's have a look at West Texas, all right, seeing as what we've been doing. Now, I'm sure if you've been trading, you'll have probably seen what has actually happened, and let's have a look at this. Okay, this is the daily chart. Okay, well, you can see for yourself. Remember what I was saying earlier, that almost there's like we hit highs there of $65, okay, in West Texas, and we have dropped far and away beneath that to a point where we were actually last week where we had a minus print, okay, on the May contract on oil futures, and that was because, as I said, oversupply, not enough demand, difficulty to store it. Okay, you have to have physical delivery for when you're trading WTI futures, which meant that basically people would you'd be getting paid to take the oil, to take physical delivery of the oil, because nobody could actually nobody could store it. Everybody, there's so much oil going around. So we can see we've gone from 65 and we're trading down around about 7, okay, on the Admiral Markets, the more MT4 platform. If you're trading futures contracts, that number may reflect differently, but what we can see is you just trade what you see at the moment. And if we look at the here we go. If we look at the over the last couple of days, okay, this is onto the 15-minute chart. We can see just from a couple of days of last week, all right, we can see price, here's the Asian session, price came down, tapped it, price moved all the way up, before hitting the other side and but going sideways. So the first tap there worked quite nicely. Okay. The next day, well, actually, you know, it really tapped it at the end of the day, okay, at the end of the session before moving up, okay, to hit its target. But many people might not have actually been there to sort of sit and trade that during the day. As you can see, it was a little bit sideways. We actually had once again the following day, okay, we tapped, okay, and actually went up and hit our target. But it came down again, okay, and it actually came down and sat on those particular levels. Today, what we had was actually we came down and it actually failed today, okay, just overextended beyond the stop. But then actually what it did do is it put ourselves in a very nice double bottom pattern there, which rallied its way up there and gave us an opportunity to sort of recover the position that we saw before the trend exerted itself. So that was just a very quick look at just the last couple of days in WTI. Okay, as I said, we've been in rather unprecedented times with the oil markets, and so it's a case of go back, study these slides, have a look at the markets and the oils. Okay, make sure you're properly prepared, and as always, I wish you the best of success in your own trading, ladies and gentlemen. And I said I'll be in Traders Yard this afternoon, and I look forward to sort of speaking to you very, very soon. Thank you.